Well, hello, valued members, and welcome to this week's edition of the weekly broadcast where we take a look at what happened, what we're looking to happen, and how we might take advantage of it. May 1st, last week, finally had that pullback we've been thinking was going to take place, and sure enough, it did. Came in with a vengeance, in particular, again, on what has been the weakest sector, which is the NDX NASDAQ. Down 2.7 there, 1.5 elsewhere. Down -5 on the year in the NASDAQ. And we'll talk about that a bit more as we get going. Still up on the Dow, still up on the S&P, but the small caps actually moved back into the red for the year. If we take a look at the general summary here, I've kind of changed things up a little bit. There's some links in here now that you can click on. I'm going to try to do this a little bit more going forward to make it easier for you to follow me. So when we get to that section, of course, we'll talk about it. Let's go to the general summary. The long-awaited correction started to happen. Man, it's been a long time coming, but it finally did kick in, and the question is, how far might it go? And if we look at that, right, and we pop in, and actually let me grab a different screen here. Let me go get the S&P 500. If we pop in the S&P 500, we might be right at it already. So here's the big bar, the quad witching bar from back in March, and that bar had volume on it, right? And if we look at, like, say, the NDX, let me pull the NDX up. All of those bars, as price came into them the first time, and so if we look at this bar here, as price came into the first time, tried to reverse, right? Then we had the Apple send this thing on farther down last week. It just couldn't gather. But if we look at the NASDAQ too, right, the same sort of thing happened as it came back into that area. It kind of respected it and tried to reverse, do a hammer reversal. Both of them failed. Both of them eventually went lower. But I suspect the S&P is going to be a little bit stronger as it comes back into that area because it's been a much stronger index. It's also the first retest region off that swing point high. There's a lot going on here. First, you got this, right? That's one possibility. The other is you're coming into the first retest region. Usually, you'll try to make it to the bottom of that on the first pull back. If it's within 6 bars, that's where we're at. And that's where this price is pushed to. It almost got there, did a little reversal, so that may also be the end of the move. You also have a little ABCD structure, right? And the ABCD structure has just completed. So when you take all those things together, right, we may have already seen, based on all of this, right, we may have already seen the pullback, and we may have already gotten the extent of it. Now, if it does push lower, where's the next levels? It's the bottom of these swing point lows, right? That would be the next levels that you would expect. If we pull up the charts over here on the weekly, you'd have to think that the push back into this area is the key area. That's what I would called out before, around 2036 or so, 2037. And so we're not that far away from some sort of a small retrace that they're going to try to bounce. And then we're going to find out if this really is going to move higher or not. Remember, when we did this before, it was the same sort of thing. You get a pullback and you get a fast move up. This one, pull back maybe into this area, and then probably a fast move back to the upside. And then it's that bounce that we always look at, right, to tell us, whether the market is going to fall or not. It's the key bounce, right? For a market to fall, the key is always the failed bounce after that first retrace. You almost never see a decline without some sort of a bounce. And so that's what we'll be having to measure against, and that's what we'll be able to measure against when it takes place. The rotation this year, right, it's holding, and it's holding higher again, but it's the exact same opposite, or it's the exact opposite set of stocks doing it. If you go back and look, and I'm going to pull up the NDX one more time here. If you go back and look at the NDX and you look at it on a weekly, last year the NDX actually went up and made new highs. It was a high here, and the NDX went over it and made a new high. That's back in the August 2015, and then December you made the new high. Now spring over to something like the S&P 500 and take a look at it. Right here, it's a different story. That August lows or the highs, right? You go all the way down, back up. This one fails to make a higher high. And so if you fail to make a higher high, what is that? That's divergence, right? NDX makes a higher high, S&P can't make a higher high, you eventually get to pull back off of it. Look at what's happening now. Here's the S&P. It's almost back to that high. That high was 2116. You made it up to 2111, almost to the swing point high. Now, go back to the NDX. And if you look at it, and we pull it back up to the weekly, not even close, right? Again, divergence. You got the NDX not even close to making a new high, and the SPX almost, well, actually it's more like that, right? The SPX has almost made a new high. And so when you compare those two things, right, you've got almost the exact opposite situation where the NDX drove it before, now the NDX is trying to pull it down, and the opposite on the S&P 500. And so we have the exact opposite case taking place. And by far the technology is the weak spot, and the other rotation into all those other stocks is holding things higher. So if you want to look at another thing, another piece of that same puzzle is if you look at all the classical measures, and I used to do all this stuff myself as recently as the mid-2000s. I was still doing this sort of measures where I would look at the number of stocks above a moving average, like a 10-day, 20-day, 50-day, all that kind of stuff that people look at. Look at the advanced decline lines, the volume on the moving average, right? Those kinds of breadth indicators, right? And there's I still have some of the books here. I wrote the programs to do them, to do the breadth indicators to give us a feel for if the breadth of the market was going to support a move up. And if you look at it now, and we go back to this chart, right, where we're looking at the S&P 500 way up here, almost at a new high, this is a broader index than the NDX 100. So last year, the breadth just wasn't there, right? The number of stocks that were making new highs maybe was this big, whereas this year, the number of stocks making new highs is that big. And so there's a huge divergence. And, the general accepted practice is that this, right, is much more healthy than that. And yeah, that's true. Of course, the weighting structure allowed the market to stay up at the highs as a result of the weighting in the NDX 100 being so heavy. So yeah, it looks better on paper, right? You've got more stocks moving up versus fewer. But those new highs that are being made, let's just go look at a stock. I'm trying to think of one that's making a new high. Actually, let's just pick a gold stock. Just take the GDX on a weekly basis, right? Making new highs at new highs, and all the stocks within this group making new highs. But take that now and put it on a monthly basis. You're not even close to where you were. And so yes, the breadth is better. We can move higher, but the stocks that are moving us are still hugely down compared to where they were. And so when you look at it from that perspective, is it really better? Well, yes, it's better, but it doesn't mean that the overall market in terms of overall price is that much better off. You're just getting a huge rally, and those things have been beaten up so much. If I look at the neoclassical measures, they give you the same things that you get here, right? The neoclassical measures of the number of trend transitions, the moving average of those trend transitions, the divergence between the price and those things, they all look the same, right? They're telling us the same picture. The problem is, does good breadth mean that this market is going to continue higher? Traditionally, that was true, but we all know this is not a traditional case anymore. It's a case of the central bankers, right, flooding the system with all this liquidity, with all this debt, and that money goes somewhere, and a lot of that money is going into the markets. And so we have these huge distortions that have taken place and continue to take place. And I don't want to rub it in so bad to say, hey, it's going to die and it's going to crap out, and everything's going to go to hell. Maybe it will. My long-term expectation is it's going to take a long time to work out of all this stuff. Years and years probably. And if I think about it from that perspective, that doesn't mean we have to crash. That could be, like I've written, that could be 10 years of this up and down stuff, a decade of this. So, I just want to put that out there as a background note and, make us, we can't forget where we are and how we got to where we are. Okay, technical summary here. The IndexX trading's like death warmed over. I had put those three components last week. If you go to the site, you pop up the site, you go in here to the comments, the archives. There was a archive here about 2-3 days ago, I believe. It was the March one. Was it the March one? Or is it the April one? This is May now, right? Let me go back up here. I want to go to the April one. And so if I look at it, let me pull this over just a little bit so you get it all in the screen. If I look at it and go back and scroll back down here to this was April 27th. I threw this out there. Apple was coming back to a price point where it should find support. And if it's going to find support, it's going to, first support, it's going to find it there. Well, we're almost there. I mean, that price point is about 93 or so. If I pull up the today's Apple chart, let me grab that. We're almost there. We're almost at 93. I mean, we're right at the place where we should start to see the bounce. You see volume starting to dissipate a little bit and so forth. You're down, 11+% last week alone off earnings. Moving to the others, right? This is what's killing the IndexX. Google. Google also, same sort of situation, should find support around this big bar's top. Where is that? It's about 704. If we go to today's chart, where we're at, we're right into it already, right? Pull it up, put the weekly on. That number was 703, I should say. And where did we trade to? 703.20. We come into it, we don't have as much volume. That says we're probably going to bounce. If I look at Microsoft, it's been stronger than the others. Microsoft, same situation. If we pop back over here, Microsoft should find support into the swing point high, and in particular these two big bars on the weekly. And if we pull up the Microsoft chart on the weekly basis here, we're going to see Microsoft also coming back into that area. That low here is 49.35, swing point high 49.54, comes into it. What does it do? Tries to bounce out of it. So the big three tech stocks that's been driving the index lower, all three are back into an area where there is support. And if we pull down and look at the XLK itself, the XLK coming back pretty hard, gets a little bit of a reversal here. If you put it on the weekly, XLK is trying to come, well, it's 2 points that it's trying to come into. There's this price point here, which was the breakdown bar, 42.50. We're already into that one. The other was this high of the low, which was 40.67. We're not quite there. So we may see the index drift a little bit lower, but the big weighting stocks that have been driving it lower have already met the first area of support. They should start to support this market. If they do, what we're going to see is we're going to see the index no longer trade down and push everything down with it. And then we may actually get a decent bounce as a result of it. So I suspect, we're going to get that bounce, and that's going to probably happen rather quickly because we're already there. So on the bright side, outside of, well, I guess that's a bright side too. We're about to get a bounce. We could get more downside after that, right? But if you look on the bright side and you go, like, say, to the Russell, and if I just click the Russell up, pop into that chart. Here on the Russell, what you see is a pullback into a swing point high on the daily, right? So that daily high is 11.1941. This pullback, even though it's coming back on more volume, realize in neoclassical, right, the tell is that when you get a breakout and it goes for more than 6 bars without a test, which is exactly what has happened, that first pullback to that test is most likely going to be bought. It's a very high probability. We're talking 90%er. So we have to expect it to get bought. If that's true, we're almost there. S&P, same thing. If I pop it up, S&P's giving us the same sort of scenario. It's back in a swing point high. I've already talked about all the things here. So that's at support. If we keep going down the list, we just talked about the NDX and so forth. And if you go down into the sectors, like if I go down to gold, gold just broke out on multiple time frames. You know I've been long here. We've been long in the charts, on the bullish charts on this. Gold also breaks out here on the daily, breaks out on the weekly as well. And just if we just keep going down the list, there's a lot of things that are breaking out. So the big picture remains that of some sort of a large consolidation versus a rollover. I'm going to pull up the NASDAQ 100 on a monthly chart. If we look at the monthly chart, right, what's happening here is this large consolidation that's taking place. We have these lows and highs, right, that area. And the question is going to be is, do we eventually break it to the downside or break it to the upside? Or do we simply test to the upside and fail, or test to the downside and fail, and stay in this range and potentially, draw out some sort of a large, long consolidation type pattern on this index? Same thing on the S&P 500, right? They're all in the same situation. They're in a critical zone here on a long-term basis. My expectation is that this is going to test the downside again before it's over. But we could sneak a little high up here before we do that. In other words, we could pop up there, make a new slightly higher high before we get more downside, in a large, fast move type situation. This is a 300-point range. If we break out on the 300-point range, we're going to expand it just like this, right? One side or the other. That could take us down to the 1500 range, which is this swing point high breakout here, right? There was a high over here somewhere that got broke. Or on the flip side, this thing could trade all the way to 2400. So, when it makes the next big move that sustains and pushes, it's going to be a big move one way or the other. And so, even though my expectation is that we have some sort of a large consolidation roll type situation that's taking place, we don't have the evidence yet that it's going to happen, right? The jury's still out. This could break to the top side just as easily as to the bottom side. What would make a topside breakout? Maybe all this money the Fed and the central bankers around the world has pushed into the system is just going to explode this market higher. We're living in abnormal times, right? The world's upside down. The last thing we want to do is assume that this thing has to roll over. It seems like it should, given the fact that we don't have good growth around the world. But as we know, we didn't have good growth around the world all this move. It was okay, but it wasn't great, right? We've had like 2% growth, 2 to 3% max, this whole move. This move wasn't because of growth. This move was because of the Fed. Right? That doesn't mean we can't do it again. I don't know how long this can go on, neither do you. And we have to be open to the idea that this thing could go a lot higher potentially. And if it does, we have to go with it. One of the main things we have to always do is we have to recognize that the market can do whatever the market wants to do. And if it does push higher, then it's upon us to go with it, like it or not, right? Throw everything else aside. Forget all the fundamentals. Just look at the technicals and go with whatever's happening. So if we continue on here, if central bankers remain the focus, they were the focus last week. You had the Bank of Japan, Fed didn't do anything. Changed its language slightly to be a little bit more hawkish in that it didn't, cite world problems. But it didn't really give any indication it's going to raise rates in June. Now, this week, all the Fed speakers are going to come out again, just like they always do. They come out and start jabbering about, what's going to happen. And I'm sure we're going to hear all this hawkish news again this week from the Fed speakers. The last session of this, a month ago, didn't make a difference. Will it make a difference this time? I don't know. The key thing is that the UUP now has broken out on multiple time frames. That's a big difference. And we know when we break out on multiple time frames, that typically leads to an extension 2 to 3 bars on the longest time frame which you get to break out. So here's the breakout on the daily, right? Breaks out. If you put it on the weekly, You have the same thing. You've got the breakout here on the weekly. And so if we take that breakout and the breakout prior, what does that mean? 2 to 3 bars extension to the direction of the break, and in this case that's the downside. If we pull that back, bring it on the monthly, right, and see what the monthly shapes up as, that monthly is now breaking this swing point low as well, or at least it's attempting to. And so if that holds, actually that did hold. Not sure why we don't have the break here. I'll have to look at this. It looks like this chart didn't get updated for some reason, but that's the break on the monthly too, which also says, you know, 2 to 3 bars extension to the downside, which means that we're probably going to come all the way back to this area if in fact that follows through. That's the key thing this week. Is the dollar going to continue to follow through to the downside? If it does, then what's going to happen? You're going to get all these things that have been breaking higher continuing to break higher. The next one that's poised to go is copper, so we should take a look at that this week. That may be a place, a fresh, fertile ground to play in this continued dollar devaluation if it continues to go forward. So what's the bottom line here? You know, central bankers' earnings, they made a dent in the market last week, but I don't know that that's going to stop this market. I suspect we're going to get that first retrace buy, just like I've talked about for a long time, probably this week. And so if I look at the scenarios here, I think the best case is that the indexes just take off and they run right back up and do about the 2110, right back up to the highs of the past 2 weeks. Worst case, some sort of an exogenous thing takes place here and we get a push all the way down to around 2310 on the S&P. What's the most likely case? I suspect we're going to get a little bit more of a retrace and we're going to head right back up. And so, you know, that's what you should be expecting. That's how you should probably be trading this market. It's not a time to get too bearish. Matter of fact, you start looking at things to buy, not to sell would be my expectation. That's it for this week. I'm a little long. I'm going to leave it at that. Thanks a lot. Take care. Goodbye.